For years, it felt like the world's big economies were all on the same team. Kind of like a synchronized swimming squad, everyone moving together. A crisis hits, they all cut interest rates. Inflation spikes, they all raise them. Well, that era of playing follow the leader, it's over. All of a sudden, the team is splitting up and everyone is swimming in their own lane. So let's get right into it.
And that's really the million-dollar question, isn't it? Why? Why are the central banks running the world's biggest economies suddenly going in completely opposite directions? And trust me, this isn't just some boring economic theory. It's a massive shift that's going to have real effects on currencies, on the markets, and yeah, even on your own wallet. And here's what that split looks like in black and white. Over in the US, you've got the Federal Reserve keeping interest rates way up there at 4.5%, trying to wrestle inflation to the ground. But then you look across the pond, and the European Central Bank is doing the exact opposite. They're cutting rates down to 2.15% because they need to give their economy a boost. They're on two totally different tracks, and that, my friends, is what economists call divergence.
So, what is this divergence thing really? Let's break down exactly what we're talking about here.
Okay, monetary policy divergence sounds super technical, right? But it's actually pretty simple. It's just a fancy way of saying central banks are going their separate ways. Think of it this way. The US economy has a fever, that's inflation. So the Fed is prescribing medicine to cool it down, which is high interest rates. Meanwhile, Europe's economy is feeling kind of sluggish. It needs a shot of energy. So the European Central Bank is prescribing stimulus in the form of rate cuts. Different problems, different solutions.
And to make this even easier to track, you'll hear people talk about hawks and doves. So the Fed, with its aggressive high rates, that's the hawk, laser focused on crushing inflation. The ECB, on the other hand, is the dove, taking a gentler approach to try and get the economy growing again. It's this exact hawk versus dove dynamic that's fueling this whole global divergence.
All right, so the banks are making different moves. So what? How does that actually change anything in the real world? Well, it all comes down to one of the oldest rules in the book: follow the money. And here is the absolute key to understanding all of this. Big money, we're talking trillions of dollars, is always looking for the best return on investment. It's kind of like water. It's always going to flow downhill to the easiest path. In finance, that path is higher interest rates. So when US rates are high, it's like a giant magnet for international cash. And that simple fact kicks off a huge worldwide shuffle of money. Now, this massive flow of money actually has a name. It's called the carry trade. And it's one of the most powerful forces out there. It sounds complicated, but the idea is dead simple. You borrow money where it's cheap, from a country with super low interest rates, then you invest that money where you can get a much higher return. You just pocket the difference, the spread, and that's the whole game. And this is a perfect example of how it works in the real world. For ages, Japan has had interest rates near zero. So a big-time trader borrows a ton of Japanese yen at, let's say, a measly 0.5%. They instantly swap it for US dollars and then buy US government bonds that are paying out 4.5%. Just like that, they're making a 4% profit. Now, imagine doing that with billions of dollars. You can see why this is such a big deal. But this massive movement of capital, all chasing after a better return, doesn't just happen in a bubble. Oh no, it sends powerful ripple effects across the entire global economy. The very first and most obvious effect is on the value of currencies themselves. I mean, think about it. If everyone is doing this carry trade, what do they all need to buy? US dollars. And what happens when demand for anything skyrockets? Its price goes up. So this huge demand for dollars drives its value way up, making it super strong compared to other currencies like the euro or Brazil's real. And while a strong dollar sounds good, it actually creates some pretty complicated problems for global trade. The second ripple hits a market that's absolutely vital to the US government: the bond market. For a long time, the carry trade was great for the US because foreign investors, especially from Japan, were buying up tons of US debt. But what happens when the music stops? And this is where things get really interesting. Japan is the #1 foreign holder of US debt. But if Japan starts raising its own interest rates, that whole carry trade starts to work in reverse. All of a sudden, Japanese investors might start selling their US bonds to bring that money back home. And if your biggest customer suddenly starts returning all their stuff, well, that could cause some serious problems in the US Treasury market. But you know who really gets squeezed in all of this? Emerging economies.
They get caught in the middle of this tug of war between giants like the US and Europe, and they're left with basically no good options. It's a real catch-22. If a country like Brazil or India cuts its own interest rates to try and help its local businesses, money will just pour out of the country looking for those higher US returns, and their currency could crash. But if they raise their rates to keep the currency stable, they risk grinding their own economy to a halt and causing a recession. It's a lose-lose choice between currency stability and economic growth. So we've got these huge global forces at play, but you're probably sitting there thinking, okay, but what does any of this have to do with me? Well, it turns out these massive ripples eventually find their way to your front door. It might feel far away, but these shifts can hit your wallet. Take the stock market. A super strong dollar makes it more expensive for big American companies like Apple to sell their stuff overseas, and that can hurt their profits. Then there's the cost of loans. All that drama in the US bond market, it can actually influence the interest rates you pay on things like mortgages. And it even changes the price of stuff you buy. A strong dollar makes that imported French wine cheaper, but it makes an American-made car more expensive for someone in another country. So what this all really boils down to is that the era of everyone being on the same page is pretty much over. We're in a new world now, one that's a lot more fragmented, where it feels like every country is just looking out for itself. This divergence of policy is really just a sign of a much deeper split. And it leaves us with one really big question. As every nation starts to chart its own economic path, what does that mean for the future of global cooperation and stability?